Today we will analyze Netflix's most recent earnings report of Q1 2026, if Netflix can be considered a buy, and why Netflix comes out as the winner of the Warner deal even though they lost against Paramount. In Q1 2026, Netflix reported a better than expected earnings result of $1.23, but this was mainly because of a one-time payment due to the lost Warner deal. Looking further back, the previous 3 quarters in 2025, Netflix reported 55 cents in Q4, 59 cents in Q3, and 72 cents in Q2. This results in an earnings per share of $3.10 over the last 12 months. As Netflix dropped a hefty 10% after they published the earnings of Q1 2026, the stock is currently trading at around $97 as of mid-April. Dividing those numbers results in a PE ratio of around 31.3, marking a hefty price cut since Netflix has a 20-year median PE ratio of 55. Netflix stock is rarely at a discount, as the past 20-year PE ratio chart indicates. During the past 20 years, the last 2 times Netflix was below a PE ratio of 20 were in 2011 and in 2022. So what triggered those severe crises of 2011 and 2022? And might we be at the beginning of such a crash again for Netflix? In 2011, Netflix had its most severe crash with negative 82% drawdown from its last peak, as Netflix tried to separate the DVD business to a newly branded subsidiary called Qwikster, while streaming was kept under Netflix. As Reed Hastings, the co-founder of Netflix, once said, "We are not in the DVD business. The only reason why we have these DVDs is to scale the customer base for what we ultimately want to do, which is streaming." At the same time, Netflix increased its prices, resulting in a massive customer backlash, with around 800,000 cancelled memberships, which were at the time around 3% of Netflix total customers. The Wall Street Journal titled Netflix Qwikster debacle as its new Coke moment. This comparison highlighted the massive backlash from the 2011 price hike and DVD spin-off plan, akin to Coca-Cola's infamous 1985 formula change that alienated customers. The Wall Street Journal reported in 1985 as follows: Coca-Cola Company, worn down by die-hard oppositions from the fans of Old Coke, reversed itself and said it will sell Old Coke alongside the reformulated version introduced in April. New Coke was discontinued in 2002. To bring the story full circle to Netflix, Coke did a small revival of the New Coke as limited edition for Netflix Stranger Things in 2019. As Qwikster was truly a New Coke moment for Netflix, the stock dropped starting from July 2011 until Netflix quickly reversed their DVD plans in October 2011. Investors who bought during such a severe crisis would have been rewarded years later with a return of 8,160% during 14.5 years and multiple stock splits, such as the 7-for-1 split in 2015 and the 10-for-1 split in 2025. So a single stock from October 2011 with a price tag of $82 would nowadays be worth 70 stocks, each worth $98, resulting in a total amount of $6,860. In 2022, Netflix had its second severe crisis, as the stock crashed by 75%, and a super low PE ratio of 16, as it reported its first subscriber loss in a decade in Q1 2022, as it lost 200,000 subscribers. The war between Ukraine and Russia led to a severe energy crisis, followed by severe inflation at peak levels of 8%. As a result, customers immediately rushed to cancel their Netflix subscription in order to cut costs. Netflix quickly reacted and introduced the budget-friendly ad tier for $4.99, and most importantly, restricted password sharing. This change not only stopped subscription cancellations, but also lifted Netflix stock from $17 up to $132, leading to the 10-for-1 stock split in 2025. Since Netflix stock peaked at $132 in June 2025, the stock tumbled again, especially after they announced to take over Warner Bros. To get access to popular franchises such as Spider-Man or Harry Potter and its HBO Max streaming service. This move was seen as an attempt to grow for the first time by buying an external competitor. What followed was one of the most intense Hollywood-style bidding wars Wall Street had seen in a long time, as Paramount Skydance started a competitive takeover bid for Warner Bros. Netflix and Paramount both increased their offers multiple times, increasing the amount of cash needed to conduct the takeover. For instance, Paramount included a ticking fee clause for Warner Bros. Investors. This means that each Warner Bros. Investor will receive a dividend from Paramount for each month if the merger is not completed, starting in January 2027. And very importantly, both agreed on a termination fee of $2.8 billion. if either Netflix or Paramount would lose the bid. But why did Netflix stock start to tank when Netflix could get access to hits like Spider-Man or Harry Potter? Simply because Wall Street hates uncertainty, plus Netflix would have to take $50 billion in additional debt, downgrading a strong balance sheet. Netflix stock lost almost 44% from its last peak during the bidding battle, while its PE ratio dropped from lofty 63 to still lofty but more reasonable 30. But considering its median PE ratio since its IPO of 55, it was considered fairly valued or undervalued. Of course, when looking at the drawdown chart, it was not in bargain territory, as it was in 2022, but still a valid opportunity to catch a small stake. And that's when brave and long-term oriented investors wake up and start buying aggressively. This time they got rewarded quickly, as on February 26, Netflix officially announced that it would decline its offer for Warner Bros., immediately boosting its stock by 42% from $75 to $107. Most importantly, Netflix rejected the massive amount of debt they would inherit from Warner Bros. And take on to finance the deal, which was Wall Street's biggest issue for Netflix with this deal in the first place. So by rejecting Harry Potter, Spider-Man and other blockbusters, Netflix might have outsmarted Paramount, as Netflix did receive the termination fee of $2.8 billion, especially since Netflix already started to leverage their own binge-worthy shows like Stranger Things, Bridgerton and Emily in Paris, not just as TV content, but as powerful brands. These shows have the same revenue potential beyond streaming as major franchises, through product placements with brands like Unilever's Dove or Procter & Gamble's Pantene Pro V. All these in-house blockbusters hits could grow into the next Harry Potter or Spider-Man franchises, even without the takeover from Warner Bros. The $2.8 billion termination fee Netflix received from losing the Warner deal boosted Q1 2026 results, delivering spectacular $1.23 earnings per share. We must carefully adjust for this one-time effect when analyzing Netflix stock. The EPS of Netflix without the termination fee in Q1 26 can be easily calculated with the help of the income statement, as the termination fee of $2.8 billion is included in the interest and other income section of the income statement. So dividing $2.8 billion by Netflix total income results in 42%, multiplied by the total EPS of $1.23, this results in about 53 cents from the termination fee and 70 cents from the Netflix streaming business, leading to a core PE ratio of 37.9 over the last 12 months, without the one-time termination fee, compared to 31.4 including the one-time termination fee. We consider Netflix at these levels a buy, especially since its PE ratios are below its 20-year median of 55 by a massive 31% and 42% respectively, while the stock price itself is down by 27% from its last peak. Thanks for watching and see you in the next video.